Credit cards explained for beginners, how they really work. Imagine buying a $50 dinner with your credit card and eventually paying $70 for it. Now, imagine using that same card, paying no interest, earning cash back, and building a credit history that may help you qualify for better financial products later. The difference is not the card. The difference is understanding how the card works. In this video, I'll explain credit cards from the ground up, what you are actually borrowing, how interest is charged, what the minimum payment really means, how a credit card affects your credit score, and the basic rules that can help you use one safely. This video is for general education and focuses mainly on credit cards in the United States. Terms vary between card issuers, so always read your specific card agreement. Let's begin with the most important idea. A credit card is not extra income. It is a reusable short-term loan. When a bank approves you for a credit card, it gives you a credit limit. Suppose your limit is $2,000. That does not mean the bank gave you $2,000. It means the bank may allow you to borrow up to that amount. When you spend $500, your available credit falls to $1,500. When you repay the $500, that credit becomes available again. This is why credit cards are known as revolving credit. Every purchase creates a debt. The card issuer pays the merchant, and you now owe the card issuer. That sounds simple. But the timing is where many beginners become confused. Your credit card activity is divided into billing cycles. A billing cycle normally lasts about 1 month. At the end of each billing cycle, the card issuer creates your monthly statement. That statement shows your purchases, payments, interest charges, fees, statement balance, minimum payment, and payment due date. Two numbers commonly confuse beginners: the statement balance and the current balance. The statement balance is the amount you owed when your billing cycle ended. The current balance may be higher or lower because it includes activity that happened after the statement was created. For most beginners, the safest payment target is simple: pay the full statement balance by the due date. Why the statement balance? Because many credit cards offer a grace period on purchases. A grace period is the time between the end of your billing cycle and your payment due date. When your card provides a grace period and you pay the required balance in full by the due date, you can generally avoid paying interest on those purchases. This allows you to use the card, receive your statement, and repay what you spent without paying interest. But when you carry part of the balance into the next billing cycle, you may lose that benefit and begin paying interest. Now, we need to discuss APR. APR means annual percentage rate. It represents the yearly cost of borrowing money through the card. However, credit card interest is commonly calculated using a daily rate and the balance you carry during the billing cycle. Suppose you carry a $1,000 balance on a credit card with a 25% APR. A rough estimate would be a little more than $20 in interest for 1 month. That may not sound serious at first, but imagine continuing to carry the balance, while also adding groceries, subscriptions, fuel, and other purchases. Interest is added while your balance remains unpaid. Over time, an ordinary purchase can become much more expensive than its original price. This leads to one of the most dangerous credit card misunderstandings: the minimum payment. The minimum payment is not the amount you should aim to pay. It is simply the smallest amount the card issuer requires you to pay for that billing cycle. Paying the minimum may prevent the account from immediately becoming past due, but it leaves most of your balance unpaid. Interest continues to accumulate, and repayment can take years. Your monthly statement includes information showing the potential cost and repayment time associated with minimum payments. Do not ignore that section. It may be one of the most important parts of your entire statement. Here is a practical payment order. The best option is to pay the full statement balance. The second best option is to pay as much as you can above the minimum. The emergency option is to at least make the minimum payment on time. Stop adding unnecessary purchases and create a plan to eliminate the remaining balance. Never confuse minimum required with financially safe. Next, understand that one credit card can have several different interest rates. You may have a purchase APR for ordinary spending. You may have a balance transfer APR for debt transferred from another card. And you may have a cash advance APR for withdrawing cash through the card. Cash advances are especially expensive. They may have a transaction fee, a higher interest rate, and no grace period. That means interest can begin accumulating as soon as you receive the cash. A credit card cash advance is not the same as withdrawing your own money from a checking account. You are borrowing money against your credit limit. Treat cash advances as emergency borrowing, not as ordinary cash. Promotional offers also require careful reading. A card may advertise 0% APR for a limited period. That can be useful when handled responsibly. But 0% interest does not mean the debt disappears. You must know when the promotional period ends, whether a balance transfer fee applies, and what interest rate begins after the promotion. You should also understand the difference between a true 0% offer and deferred interest financing. With deferred interest financing, failing to repay the full promotional balance by the deadline may cause interest to be charged based on the earlier balance and promotional period. Do not look only at the large 0% advertisement, read the complete terms. Now, let's connect credit cards to your credit score. A credit score is designed to estimate how likely you are to repay borrowed money. Different scoring models exist, and lenders may use different versions. However, responsible credit card use can help you build a positive credit history. For commonly used FICO scores, payment history is the largest scoring category. That means paying your bills on time is more important than chasing rewards, points, or complicated credit card strategies. Another major factor is the amount of debt you owe, including your credit utilization. Credit utilization is the percentage of your available revolving credit that you are currently using. Suppose your total credit limit is $2,000 and your reported balance is $500. You are using 25% of your available credit. A commonly recommended guideline is to keep utilization below 30%, but lower is generally better. 30% is not a magical number where everything below it is perfect. Someone using 5% of available credit generally appears less dependent on borrowing than someone using 29%. Assuming everything else is equal, this is also why closing a credit card can sometimes reduce your score. Imagine you have two cards with a combined limit of $10,000 and a balance of $2,000. Your overall utilization is 20%. Now imagine closing one card and reducing your total available credit to $5,000. That same $2,000 balance now represents 40% utilization. Closing an account does not always damage a score, and there may be valid reasons to close one, but you should understand the possible effect before making the decision. Here is another important credit card myth. You do not need to carry a balance or pay interest to build credit. You can use your card for a small purchase, allow the account activity to be reported, and then pay the full statement balance. Paying interest does not earn you extra credit score points. Now, let's discuss rewards. Cashback, airline miles, and travel points can provide value, but only after responsible payment habits are established. Suppose your card gives you 2% cash back. Spending $1,000 would earn $20, but if carrying that balance costs you more than $20 in interest, your reward has already been erased. Never spend $100 just to earn $2. For a beginner, a simple card with no annual fee may be more useful than a premium card with complicated travel benefits. An annual fee can make sense when the benefits you genuinely use are worth more than the fee, but imagined future travel does not count as value. Only benefits you actually use count. Before applying for a card, review at least 5 things: the annual fee, the purchase APR, the late payment fee, the foreign transaction fee, and the rewards rules. Also check whether you are completing a full application or only checking for pre-qualification. A full credit card application will commonly result in a hard inquiry appearing on your credit report. Some pre-qualification tools use a softer credit check, but the process varies. Read the disclosure before submitting your information. Do not apply for several cards simply because each one offers a welcome bonus. Multiple applications, new accounts, payment dates, annual fees, and available spending limits can quickly become difficult to manage. For your first credit card, boring is good. Choose one manageable card. Place 1 or 2 predictable expenses on it, such as a streaming subscription or monthly phone bill. Keep enough money in your bank account to cover every purchase. Turn on transaction alerts. Set automatic payment for at least the minimum amount as protection against accidentally missing the due date. Then manually verify that the full statement balance is paid. Auto pay is helpful, but do not stop reviewing your account. Check your statements for unauthorized charges, duplicate transactions, subscriptions you forgot about, unexpected fees, and changes to your card terms. Your credit card should also have a clearly defined job. Maybe its only job is paying one monthly bill and building credit history. Maybe it is used only for planned grocery purchases. Clear rules reduce emotional and impulsive spending. Here are the 5 beginner rules worth remembering. Number 1. Treat the credit card like a debit card. Do not charge an amount unless the money already exists in your budget. Number 2. Pay on time, every time. Number 3. Aim to pay the full statement balance, not merely the minimum payment. Number 4. Keep your reported balance low compared with your total credit limit. And number 5. Ignore rewards until the first 4 rules have become automatic. A credit card is neither free money nor automatically bad. It is a financial tool. Used responsibly, it may provide convenience, fraud protections, rewards, and a path toward building stronger credit. Used carelessly, it can turn small purchases into expensive, long-term debt. The smartest credit card user is not necessarily the person with the most cards, the largest credit limit, or the most travel points. It is the person who always knows three numbers: the statement balance, the payment due date, and the amount of money available to pay the bill. Before you use your credit card again, open your account and find those three numbers. If this video helped you understand how credit cards work, subscribe for more simple and practical financial education. In the next video, we'll break down exactly how credit scores work and the common mistakes that can quietly damage them.